Berman here, and what a start to the year. In fact, one of the best starts to the year ever, especially if you own large cap technology. Let's dig into the chart room and see what we learned this week. So the first thing I want to look at here is the one of the newer indicators out. I mean, it's been out for a little while, but the Dallas Federal Reserve has an indicator where they measure core personal consumption expenditures. So PCE inflation, the Fed talks about that a lot. It's their main indicator. They talk about a core. And so when you look at the numbers here and we look at the trim mean, you're really looking about what is the average price doing. And so that came in at 4.6, and you can see that's a year-over-year number, 12-month number. If you look at the 6-month trend, you can see very similar numbers. So slightly better on the 6-month trend, down at 4.3, but really, still very, very elevated from the Fed's 2% goals. When you break it down graphically, on the white here, these are items that are actually falling in price. So about 20% of the universe of prices are actually in decline right now. Prices that are up year on year, 0 to 2%, expanded in May. You can see that number from when it was April, increased in May. The number of items that were up 2.3% declined a little bit, and the numbers that were up 3 to 5 has declined quite a bit. So that's really been the big difference in terms of the prices that are falling and were already lower. Increasingly, we're down. The items that were, going up more than 10% stayed about the same, slight decrease. And the number, the items that are increasing 5 to 10% stayed pretty constant, although fell slightly also in the month. So again, when you think about the mean, you look at the middle and you see, well, what is that? So the median and the middle number really still in that, 5% range. So 4.6 is the number. Higher than the Fed wants. It supports the notion of higher for longer. All the economic data that's come out in the last couple of weeks has supported the notion of higher for longer. When we heard from the Fed and other central banks this week, with the exception of Japan, the message is higher for longer. In a higher for longer world, what you end up getting is this is actually a slight positive for equities. But it's a positive for equities until it isn't, meaning they've got more work to do. Interest rates are going to keep trickling up, and eventually it breaks. Peter Bookfar, an independent economist that we follow, was on Rosenberg's webcast this week. And, he talked about every day he's hearing it in earnings reports and he's seeing evidence that things are breaking slowly. And so this is a process. It's not an event per se. And for now, equity markets just simply don't care. Investors on average just don't want to miss the Fed stopping, pausing, pivoting, whatever you want to call it, skipping. And so money keeps flooding into equity markets. So speaking of the great start to the year, we're looking at the NASDAQ 100 index here. And the candlestick chart is showing the year-to-date number from the last traded day of 2022 to today's close, or Friday, the June 30th. And then the equivalent data going back to 1999, first half of the year. And you can see that it's just a remarkable year. All will know the NASDAQ 100 doubled in 1999, up 100%. So The cheerleaders are telling you it's a great start to the year, and history will tell you it's going to be even better in the second half. There's so much excitement and enthusiasm over artificial intelligence. Very few people are starting or are questioning, should Microsoft be trading at 35 times earnings, and is it really worth it? Great company. I love it at 25 times earnings. At 35, I got to question the valuation. It's that simple. And so we're seeing extreme valuations in the leadership names that have been leading this charge on the NASDAQ. If you look at the NASDAQ in its entirety in 1999, again, you can see that doubling. A big chunk of that came in the last quarter of the year, where it just became, an outright just get me in. So are we going to finish the year that way, or is the Fed tightening cycle and higher for longer going to start having a real impact on the economy? We heard it a little bit from Nike this week. We've heard it from FedEx. We heard it from General Mills this week. It's getting harder to pass through prices. Consumers are trading down product. To me, that's a sign of stress. The top half that have surplus savings are going to continue with their surplus savings and are going to be okay. And it's really not going to start having an impact until we get a shock to the labor market. So, when we look then at the U.S. Employment picture and what we're going to get this coming week from employment, slide down the chart here and see the expectations for non-farm payroll are another pretty robust 200K, 225 overall, 200 excluding the government jobs. And that's just really, going to cement the Fed doing a rate hike in July at this point. If you look at what's priced into the market in terms of interest rate probabilities, we can see that an 81% chance of a rate hike is priced in, starting to move towards 2 rate hikes being priced in. Powell had kept that on the table. Every meeting's live. So, we'll see. But the stronger the labor market is, the more lifting the Fed has to do, the more damage they're ultimately going to do, and the harder the landing probably is, which the equity markets are just completely not reflecting at all on this point. At this point, when we look at what's gone on in June and year to date, again, we can see that the S&P 500 by far, total return year to date of almost 17%, compared to the equal weight index, which is now up 7%. A month ago, when we looked at this, the equal weight index was down on the year. So on the month, we actually had a pretty decent month for the average stock. So we did see breadth improve. The equal weight index in the month was up 765 total return versus 648 for the broad S&P 500. So that broadening of trend is a good sign that the average stock is started to do better in the month. Only a week ago, that was back to neutral, and then it broadened out again during strength. So those are good signs. The bulls will tell you that's an encouraging thing. I'm not going to refute that. It is better when the average stock moves forward. No doubt about it. No questions. Nope, that's not good. It's very, very true. The question you have to ask yourself is, what is the catalyst to make that continue, other than the hope and expectation that the Fed stops raising interest rates and starts cutting them? The only way the Fed is going to cut interest rates on the higher for longer island is the hard landing scenario where we start to lose jobs rapidly. Now, in that environment, is the equity multiple going to stay where it is? Are earnings going to stay where they are? And the answer to that, to me, is a hard no, which speaks to the mispricing of the environment we're in. So, again, that's really it from a snapshot perspective of what June was and what we're thinking going forward. Again, bull and bear pick of the week. We've given you some of our bull thoughts in recent weeks. Natural gas market is moved. We still like precious metals here, but again, as we reminded last week, the catalyst needs to be the cutting of interest rates for gold to start working here, and we think that's quite a while off. So it's an accumulate on weakness in the bullion space. In terms of industrial metals, again, we like it, but with an economic weakness we think is coming in a harder landing that is not priced in, those kind of underperformed for a while. And we think this week's meeting at OPEC, where they're really going to be serious about getting oil prices up. Obviously, that's not good for inflation. But the fact that oil prices haven't stuck speaks to the underlying economic weakness, we believe, that's there, that equity markets just aren't pricing because they're pricing for just a perfectly soft landing at this point. And that's, for the most part, fully reflected already. So caution overall, don't get lulled into it. Don't be a chaser. The last few days of the month was clearly a lot of window dressing where managers that have been lagging, put your hand up if you're one of them this year, because of that not being exposed to large cap tech. Our portfolios did better this month because we're more exposed to the average stock than we are to the market cap stock. So bit better month for us in the portfolios, but really still lagging because we are just not full on equity market risk. And that's just something that is going to be part of our recommendation going forward. I've never been a chaser. I can't ever recommend you chase it unless your trading time frame is extremely short-term focused. That's it for the week. Have a good one, everybody. Have a great holiday weekend, and look forward to getting into the hotter summer months.